Last week, I said that we're at the beginning of a world trade boom and indeed a world commodities boom, which was going to last for at least the next few years. Next week, we should see my updated set of commodity models available to the network. What these models show is that even though prices for a number of commodities have gone up in metals and other resources, and indeed for agricultural commodities, most of those commodities are now really, really close to fair value. That is to say, they're sustainable at these higher levels, and they're sustainable at these higher levels for a considerable period. One of those that I want to talk about this morning is iron ore. In the first slide you'll see is Chinese steel production. China has been talking about has been attempting to talk down the iron ore price in the last few months, and it's been talking about its reduction in the amount of steel that it's producing. But really, all it's done is it's reduced its level of steel production from stratospherically high levels to a lower level of the stratosphere. This year, China reached an all-time record monthly production of steel of 99.5 million tonnes in May. Since then, production has declined to 93.9 million tonnes per month. Now, if we compare that to previous years, last year the previous all-time record high was in August at 94.8 million tonnes per month. So really all that has happened with Chinese steel production this year is they've reduced it from this year's all-time record high down to about the same level as last year's all-time record high. So these are extremely high levels of Chinese steel production. Marx and Lenin would be proud as they if they looked at this level of iron and steel production in China. China produces over half of all of the iron and steel in the world on an annual basis. But really, these very, very high levels of Chinese steel production can continue to generate very, very high levels of demand for iron ore and Australian iron ore. Now, what we can see is, we can see the level of iron ore stocks at port. Iron ore stocks at port peaked back at 145 million tonnes in 2018 and then fell to a low of 92 million tonnes in June 2020. Now, it's that which, after a lag of 2 to 3 quarters, generated the escalation in the iron ore price. We've then seen a slight build-up, but that slight build-up is to 115 million tonnes. Now, to put that in perspective, what we then do in the construction of our model is we construct the stocks to consumption ratio on chart number 3. And this is how all commodity models are constructed, by looking at the level of stocks relative to the level of demand. We generate that by looking at the data in the previous 2 slides. And what we can see is that the level of stocks relative to consumption is really at the lower end of the scale for the last decade and a half. And so stocks to consumption ratio says the iron ore situation in China is still really quite tight, and that suggests higher prices to be maintained at the higher end of the range rather than any kind of major slump. So what's actually happened with iron ore is that it's fallen back to around about fair value in terms of our model. And that's what we were saying, is we've seen that in a number of different commodity models, that prices have gone up but are around about fair value. Now, we said last quarter that we thought that fair value for iron ore was about $140 a tonne. Now that's lifted up to just under $160 a tonne. The iron ore price was way over the top of that, and it's come back to around about that level. And what we think is going to happen with the iron ore price is similar to what happened between 2011 and 2013, and that is that with relatively low levels of stocks to consumption ratio, it will stabilise at these relatively high prices for in coming years. And that's really supported, like I said, by a world trade boom. It's not just a world trade boom for steel, it's a world trade boom for base metals, it's a world trade boom for agricultural products. And all of these are now being supported much higher prices this year than they were a year ago. And we expect this world trade boom to support these prices for at least the next 2 or 3 years. So this is a very good period for which the Australian economy is right in exactly the right position to take advantage of.